Hey traders, welcome back to Immortal Trader channel. Today we are diving into the bread and butter of trading, support and resistance. I know you've heard about it a million times, but hold up, stay with me and I promise I'll show you a fresh perspective that'll make you see these levels in a whole new light. If you're new here, stick around till the end. And if you don't vibe with this video, go ahead and hit dislike and report it. I'm that confident you will find value here, so let's dive in. Subscribe, hit the bell, and let's get started. Why support and resistance are your trading superpower? Support and resistance aren't just lines on a chart. They are the heartbeat of the market. Master these and you can make consistent profits. Seriously, you don't need to memorize every candlestick pattern or indicator out there. Support and resistance alone can be your ticket to trading success. Just follow along videos and I will break it all down for you. How do support and resistance for? Let's start with these basics. Why do these levels even exist? It's all about psychology and supply and demand. Humans love round numbers. $1,000, $5,000, $10,000. We are drawn to them, like moths to a flame. When a coin hits a round number, like 4,000, traders instinctively see it as a good price to buy or sell. That's why these levels often act as support or resistance. For example, imagine a coin drops to $2,000, a nice round number. Traders see it as a bargain and start buying, creating a support level. On the flip side, it hits $10,000. Sellers might jump in, thinking it's overpriced, forming a resistance. It's not magic. It's just how the collective psychology of the market works. We are all part of this crowd, and our decisions shape these levels. When demand outweighs supply, the price shoots up. When supply takes over, the price drops. For instance, if everyone wants to buy a coin at $3,000, but there aren't enough sellers, the price climbs. Conversely, if sellers followed the market at $8,000, the price tanks. These battles between buyers and sellers create support and resistance zone on the chart. Drawing support and resistance on the chart. Let's get practical and head to the chart. To draw a support or resistance line, you need at least 2 points where the price reacts, either bouncing back or getting rejected. For example, here we have 4 points to draw a support line, or here we have 2 points to draw a resistance line. At least 2 points, but we use more than 2 points to draw our lines. Technical analysis is an art, not a science. The prettier your lines look, the more likely they are correct. Why? Because the market is driven by humans, and humans are drawn to clean and obvious level. Let's draw lines step by step. Start with higher time frames. Go to the monthly or weekly chart first. its monthly chart. I spot a level at 120 where the price bounced multiple times. Boom. That's a support. And you can draw lines with Alt plus H or here. Horizontal line. I draw a line connecting those points. Refine on lower time frames. Drop to the daily or 4 hours chart and adjust your lines. We go on daily chart. If the price recently reacted to 117, yes, if the price recently reacted to 117 instead of 120, twerk the line to make it prettier. Recent price action, I mean right side of the chart, is always more important than all data, I mean left side. Here are the recent datas, and these are more important than left side, all data. If a line connects more candles cleanly, whether from the body or shadow, it's likely more valid. Don't overthink it. If it looks good, it probably is. For example, on a daily chart, I see the price hit 190. Yes, here. Let's draw a line, resistance line. Here. I see the price hit $190, got rejected and dropped. It came back, hit it again and dropped again. That's a resistance. I draw my line at 190. Making sure it touches the most recent reactions. If it's cleaner from the candle bodies, I use those. If shadows make it look better, I go with shadows. It's an art. And don't worry about some expression like bodies and shadows. We will talk about it in that own session. But it's shadows, okay? It's shadow. And it is body of the candle. We will talk about it. Don't worry. Why right side data matters more than market involves. Just like we do. A level that worked 6 months ago might not hold today. Because traders' emotions, strategies, and the world around us change. Always prioritize recent price action. If a resistance was strong last year, but the price just smashed through it and retested it as a support, update your chart. The right side of the chart is where the action is. Let's break down some golden rules. Breakouts. When a support breaks, the price typically falls to the next support. If a resistance breaks, it climbs to the next resistance. For example, if the price closes below a $190 support on the daily chart, expect it to drop to $117, the next support. A broken support becomes a resistance, and a broken resistance becomes a support. Why? If traders bought at a $190 support and it breaks, they are now in the red. When the price returns to $190, they sell to breaks even, turning it into a resistance. After a breakout, the price often pulls back to test a broken level. If a resistance at $190 breaks and the price closes above it, it might dip back to $190 to test it as support before continuing upward. This is due to market inertia. Prices don't like sudden changes. How I trade support and resistance. There are two ways to trade these levels. Buy at support, sell at resistance. Wait for the price to hit a support. Confirm with a strong candle and buy. Sell when it hits resistance. My preferred method, I wait for a support or resistance to break, then enter in the direction of the breakout. Why? Breakouts are faster and more explosive. Let's talk about stop loss. Place it just below the broken level for longs or above it for shorts. For example, if I go long after a $190 resistance breaks, my stop loss goes at $170 to protect against a fake breakout. My target is aimed for the next major level. If I'm long at $190, my target might be $230, giving me a 1-to-2 risk to reward ratio. Avoiding common mistakes. 1. Don't be the first to act. If you are selling at a resistance, wait for at least 2 rejections. Don't jump in on the first touch. Let the market confirm it. 2. Avoid fake outs. If a breakout look too sharp, like a veil candle with a massive spike, skip it. Wait for a clean close above or below the level on your time frame. Always use a stop loss. If you are trading without one, you are gambling, not trading. Risk 1-2% of your account per trade, and you will survive the inevitable losses. Mindset matters. Trading isn't just about lines. It's about discipline. Look in the mirror, hype yourself up, and stick to your plan. The market doesn't care about your feelings, so don't let them derail your trades. Final thoughts and call to action. Support and resistance are all you need to start making money in trading. Keep it simple. Draw your line. Wait for breakouts or reactions, and manage your risk. Now, go to your charts and practice. Draw some levels on a daily chart. Drop to a 15-minute chart and see if the price respects them. Share your findings in the comments. I'm dying to hear how it goes. If these videos help, smash that like button, subscribe and share it with your trading buddies. Got questions? Drop them below and I will answer. Let's keep it simple and profitable.